Well, it is 16 minutes before 8, and the South African economy could have been 1 trillion rand larger and created about 2.5 million more jobs had the country kept pace with other emerging markets and Sub-Saharan African economies over the past decade. Now, these findings are revealed in a report titled 10 Years After the Lehman Collapse, South Africa's Post-Crisis Performance in Perspective. And the report focuses on the size of the economy, employment growth and revenue between 2010 and 2017. And Economist Harri Kemp from the Bureau of Economic Research is the author of that report, and he joins us now from our Parliament studios. Harri, thank you so much for making the time.
Good morning. Happy to join you.
So, Harri, let's start here. The report looks at the size of the economy, issues such as employment growth, and also shows that the underperformance in South Africa's revenue base is what got us to the point where we find ourselves now. But explain to us, what were the parameters that you were working within?
So, as the headlines are quite alarming, as you mentioned, the 1 trillion rand economy could have been 1 trillion rand larger. We could have created 2.5 million more jobs. As usual, the research itself is a bit more circumspect. So what we did is we just looked at South Africa's performance post-crisis, so post the global financial crisis, and compared our economic growth performance with other different country groupings. As you mentioned, we compare our performance with emerging markets in Sub-Saharan Africa, but we also look at global average growth. We looked at other commodity exporting countries, other commodity exporters, excluding the oil exporting countries, to kind of get an idea of where South Africa sits internationally. And what we then did is we saw that South Africa underperformed quite substantially against all these different country groupings. And all we did then is assume that South Africa followed the trends in these different country groupings and see where we would have ended up in 2017. So if we had followed emerging market trends or sub-Saharan trends, then you get to the figure of about 1 trillion rand in 2017, by 2017. But in our view, a more apt comparison is looking at average global growth. If we had followed global growth trends, the economy would have been about 500 billion rand bigger. And this is the same number we come up with if we just use historical domestic growth. So if we look at our growth rate over the long term of about 3.5%, if we'd followed these trends, the economy would probably have been about 500 billion rand larger in 2017.
But why were we not able to follow those trends?
So in the report, we also talk about the different factors influencing South African growth. So we are a small open economy and we are exposed to international developments. And that's why we looked at different country groupings to see if we can find countries or economies that are exposed to the same kind of external shocks. And even accounting for that, we still found that we underperformed relative to these other emerging or these other country groupings. So in our view, there's domestic factors that really impacted on our economic performance over the last 10 years. And as we mentioned in the report, a large part of these domestic constraints, we think, have to do with political and policy uncertainty that has been rife over the last couple of years specifically. And the impact that this has had on private sector business confidence, on consumer confidence, that really spilled over into real economic activity and lower growth, lower investment, lower employment growth, etc.
And that, of course, is a very, broad description of what the problem actually is. But if we were to zoom in, what would we actually see there, Harri?
So domestic constraints, I already mentioned policy and political uncertainty. And I think that is a broad concept, or it is, as you mentioned, a broad topic, but we feel that really impacted on investment decisions, specifically on the private sector side. And if we think of specific policies and kind of mismanagement that impacted on consumer confidence and business confidence, you can think of the SARS saga that's playing out very publicly in the Nugent Commission now. You can think of the visa regulations that came in a couple of years ago that really hit the tourism industry. You can think of the uncertainty in the mining sector, if we think about the delays in the mining charter, and all this uncertainty feeds into an inability of the private sector or unwillingness of the private sector to invest.
And then, of course, one of the other issues, the figures that caught my eye here was, of course, our debt to GDP ratio. And 28% in 2007, 2008, and in 2017, 55%. So our debt to GDP ratio has effectively doubled in the past decade.
Exactly. So what you normally want in a situation like the global financial crisis, or if an economy is in large strife, you want the government to step in to kind of smooth out this transition. So you would expect during periods of economic stress that your debt levels will tick up, and also because growth is lower, that ratio automatically increases. But what's happened since the financial crisis is spending, and specifically current spending on the part of government, has really remained high and remained elevated. And specifically, if we think of current spending, the wage bill, we've seen the new wage agreement earlier this year that adds more pressure on the spending side. Combined with that, the economy is underperformed, and so revenue receipts is also underperformed. And so we have pressure from both sides, from both the expenditure and the revenue side on government accounts. And this has really contributed to the escalation in public sector debt.
Harry, as a layperson, when I look at that, I'm alarmed. But should I be?
At this stage, I think we can be a bit alarmed if we think of the driving factors after behind the escalating debt. As I mentioned, current spending is a big driver. Revenue under recovery is a big driver. If we had had spending on the side of infrastructure that really pushed government expenditure, this wouldn't have been such a bad number, because infrastructure spending might lead to more growth down the road, which would improve this ratio. But because spending has been focused more on the current spending side, and we're not sure about the efficiency of the spending or the effectiveness of the spending, it is a reason to be concerned, especially given that we do not expect the economy to improve substantially over the next couple of years. So we won't be able to grow ourselves out of this debt problem.
And of course, the employment crisis, that also seems to be exacerbated over this period. What's your take on that?
Exactly. As I mentioned, or as you mentioned as well, if we had kept pace with emerging markets, we could have created around 2.5 million more jobs. So this is the part of the report that is a bit more, I want to say, soft, because we don't delve deep into labor law and labor legislation and some of the structural factors that are keeping employment growth low. But we look at historical relationship between economic growth and employment growth and try to see what would have happened if we kept pace with other country groupings. And just through that historical relationship, in terms of the relationship between growth and employment growth, we see that we really lost out on a lot of job opportunities over the last 10 years.
And then the tax implications, and you go into a bit of detail on that as well. And if you could just touch on that, because that is quite topical at the moment, given what's happening with the revenue service and, of course, the under-recovery in taxes here in the country.
Exactly. So your revenue collection is a function of both economic performance, so the performance of your tax base, so that would be income growth, economic growth, consumer spending in the case of VAT, but it's also a function of the efficiency of tax collection. So over the last couple of years and over the last 10 years specifically, we've had this underperformance in the economy in general, so you would have expected to see lower revenue growth than under the counterfactual, where we'd actually kept pace with global growth. But we've also seen an erosion in the efficiency of tax collection, and this is becoming all the more clear with the current commission. So we've had this double whammy on the tax side that's really hit revenues, both the underperformance of the economy and less efficient tax collection.
Harry, I just want to put our viewers in the picture as well, just to share with them some of the figures, you know, what exactly we're talking about in comparison to other countries, the world, and also Sub-Saharan and other emerging market venues. So from 2000 to 2007, our growth in South Africa was at 4.3%, the world 4.5%, emerging markets 6.6%, and in Sub-Saharan Africa, the growth rate there was also 6.6%. 2008 to 2009, 0.8% for South Africa, 1.4% for the world, 4.3% for emerging markets, and 6.2% for Sub-Saharan Africa. And then in 2010 to 2017, now here, 2% growth for South Africa's GDP compared to 3.8% for the rest of the world, 5.3% compared to other emerging markets, and 5% is what Sub-Saharan African countries on average were growing their GDP by in that same period. So looking at that, we touched on SARS. What about entities like Eskom and other state-owned enterprises? And where I'm going with this is, how much does corruption have to do with this picture that is emerging here, Harry?
So we don't talk about corruption specifically in the report, but you mentioned the other state-owned enterprises, and that's a very important point. If you think of Eskom and the electricity provision problems that we've had over this decade, the restrictions on the power grid, if we think of some of the other state-owned enterprises such as Prasa, who have their own problems, Transnet, we had the locomotive scandal there, where the locomotives didn't fit our tracks. So obviously corruption has a very direct impact on the management of these state institutions, which then have an impact on economic performance. Obviously, if you do not have electricity, you can't have big industry. If you do not have effective transport, you're really crippling the economy. So this obviously played an important role over this decade. The mismanagement of these state-owned enterprises played an important role in the underperformance of the South African economy relative to these other country groupings that you mentioned.
And just a final question, Harry. We are, of course, still in that downward spiral. So what needs to be done now?
So yes, you mentioned we're in the downward spiral. If our own forecast for 2018 and 2019 play out, the 2010 to 2019 decade looks to be the worst post-World War II growth decade in South Africa's history. So we're really in the doldrums. And as I mentioned earlier in the interview, one of the key factors that led to the underperformance, at least on the private sector side, is this lack of private sector confidence. This fact that policy uncertainty and political uncertainty weighed on private sector confidence. What we need now is we need private sector confidence to pick up and to be sustained at this higher level. And for this to happen, we need more policy certainty in specific key areas. Now, I think the new administration is doing a relatively good job. It's trying to sort out the state-owned enterprises, the problems there. The economic recovery plan announced by President Ramaphosa included things like re-looking at the visa regulations, looking at telecommunications. So these are all short-term things that can be done to boost private sector business confidence. Over the longer term, we need to look at more structural factors like skill shortages in the labor market, which plays into educational reform, more sustained improvement in state-owned enterprise management, etc.
Well, Harry, thanks so much for your time this morning. And that was Harri Kemp, an economist from the Bureau for Economic Research, on how the economy could have, at this point at least, been R1 trillion to the good since 2010 until 2017, had certain things happened or others not happened. Well, we're going to go to a break, and after that, we'll bring your latest news.